A book on the shelf is just paper. A book in your mind is power. Welcome to Season 1, Money and Mindset. We are here to rewrite your internal script. Let's decode.
Here's why this book matters more than most people realize. It explains why intelligent, hardworking people still lose financially.
Not because they earn too little, but because they don't understand the game they're inside.
Money doesn't reward effort.
It rewards structure, positioning, and survival over time.
Today, we are decoding Money, Master the Game by Tony Robbins.
Not as a promise of wealth, but as a map of how financial systems actually work.
Our mission today is to really look at the underlying rules, the systemic architecture that's revealed in this material. We're going to examine the mechanics.
The mechanics of wealth creation, yeah, but also risk transfer and psychological control.
Exactly. And the goal is pretty simple.
Yeah.
It's for you, the listener, to stop playing this financial game unconsciously.
Right. To really recognize how important it is to master not just, the numbers on a spreadsheet, but the psychology.
The psychology and the hidden structure of the whole system. We want to understand the nonlinear rules of this world.
So to really get a handle on the game we're all playing now, we first have to recognize something.
What's that?
The rules. The financial rules we all live by today. They aren't some, ancient, unchangeable laws of nature.
Right. They're inventions.
Exactly. And pretty recent inventions, actually. Let's start with a big one, something most people just accept as a given.
Retirement.
Retirement. We treat it like it's this sacred stage of life, the big reward for all your work.
As if it's always been the standard expectation for everyone.
But historically, that's just not true. For most of human history, people worked until they physically couldn't.
There was no golden years concept.
None. The whole idea of a guaranteed period of leisure, financed by your past work and backed by your employer, that's a 20th century anomaly.
And it really only served, a generation or two?
Yeah.
The people who got traditional pensions?
That's it. And now we're in the situation where we're expected to finance our own retirement that, thanks to medical advances, could last 20, 30, maybe even 40 years.
And we have to do it ourselves.
We have to do it ourselves. And that brings us to the core systemic shift that really kicked off in the U.S. around the early 1980s.
The move away from traditional pensions.
A seismic move. Away from what the industry calls defined benefit plans toward the 401k and other defined contribution plans.
And this wasn't just a small tweak in accounting.
No, this is a fundamental transfer of risk.
Explain that. What does that transfer actually look like?
Well, a traditional pension, the defined benefit plan, that was a promise from the company.
A guarantee.
A guarantee. They promised you a specific, predictable stream of income when you're retired. The company carried all the risk, the management risk, the longevity risk, the market risk.
They held the bag.
They held the entire bag.
Yeah.
But then the 401k came along. It started as this obscure provision in the tax code.
A loophole, really.
A loophole for highly paid executives to save more money, tax deferred. But then corporations saw an opportunity.
A massive opportunity.
A way to get rid of enormous future liabilities from their books. So they shifted the entire cost, the obligation, and all that market risk right onto the individual employee.
Think about that for a second. The entire relationship between labor and capital just fundamentally changed.
It did. What was pitched as this great opportunity to participate in the market, in American capitalism, it actually turned into this profound mechanism for corporate risk transfer.
And now we have a system where nearly everyone is personally responsible for their own long-term financial survival.
A system that, according to experts like the economist Teresa Ghilarducci, has, quote, failed for most people.
And why? It's not because saving money is a bad idea.
Not at all. It's because the expectations placed on the average person are just. They're completely unrealistic.
Her analogy is perfect here.
It really is. She points out that the system expects you, an individual without professional training, to get the same results as these huge multi-billion-dollar money managers.
She asks, would you pull your own teeth?
Or do your own electrical wiring? Of course not. It's an impossible set of requirements for an amateur.
Let's just list some of them. An individual has to figure out when they'll retire.
When they'll die.
How much inflation is going to eat their money.
And save consistently. Maybe 7% of their income, maybe 30% if they start late.
And earn, 3% or more above inflation every single year without fail.
And then, after all that, You have to manage your withdrawals perfectly so your last dollar runs out the day you die.
It's not a system. It's a high-stakes guessing game, a terrifying one.
And that's why failure is almost engineered into it for anyone who isn't incredibly disciplined or, wealthy enough to hire top-tier help.
Because the second you make it voluntary and self-directed and run by a for-profit industry,
You introduce variables that just completely undermine the individual's chance of success.
which leads us to where the guaranteed money is. It's with the industry itself.
Right. We hear the casino analogy all the time. Steve Wynn, the billionaire mogul, built his empire on one simple truth.
The house has the edge.
The house always has an edge. But even in a casino, a high roller can walk away with millions. The house can actually lose on any given night.
But that's not how it works with many mutual fund companies.
Not at all. They're what the book calls the ultimate casino, with a deck that's completely stacked. Because they are guaranteed revenue whether you win or you lose.
Hey, the house always wins, even if your portfolio is down 30%.
Their fees keep coming out. This is the core conflict that the late David Swenson from the Yale Endowment talked about.
He said the greater the profits for the service provider, the fund industry.
The lower the net returns for you, the individual investor. Their profit motive, which is maximizing fees, is in direct conflict with their supposed duty to you, which is maximizing your returns.
They get paid for selling you the shovel, whether you find any gold or not.
Exactly. And this is why you have to understand the architecture. If the system rewards the seller more than the buyer needs a system to counteract that.
So it's this incredibly high-stakes game. And yet, what do most people do?
Well, they know they should be suspicious. They've seen the bubbles. They've seen their accounts go down.
But the constant noise, the conflicting information, buy this, sell that, here's a new strategy, it just leads to overload.
Total overload. So they default. They put their financial lives on autopilot.
Their strategy becomes hope.
And that collective behavior is just perfectly captured by this chilling analogy of the wildebeest at the river.
Oh, that's a powerful one.
The herd knows it can't just sit on the bank.
Because inflation, the slow, quiet crocodile, will eat their cash.
So even though they know there are other crocodiles in the water pack, crashes, hidden fees, recessions, they have to cross. So they take this, calculated risk with everyone else.
They join the herd, not out of confidence, but out of a fear of being left behind, a fear of inaction.
They rely on inertia. They cross the river hoping they're one of the lucky ones, but they're just part of a stampede, which makes them vulnerable.
And that systemic blindness, failing to see the risk transfer, the fee structures, the power of inertia, that's the first huge barrier.
You absolutely cannot master a game if you don't even know you're playing it or what the rules are.
So if the system is stacked against the amateur, the immediate sort of gut reaction is, okay, I just need to work harder. I need to earn more money.
That's the intuitive response, yeah.
But the book makes this really strong counterintuitive point. Effort does not equal wealth.
That's right. Most people focus their entire financial lives on the linear output of their labor.
Chasing the big salary, pulling all-nighters.
Looking for that one big score, believing that if they just put in enough high-intensity effort, it will translate into lasting wealth.
But the core idea here is that for most people, their earned income, it doesn't matter how high it gets, it will never be enough to bridge the gap.
Never. Because earned income is linear. It's additive. You trade 1 hour of your time for a set amount of money.
And that trade, that linear exchange, it just can't compete.
It cannot compare to the geometric multiplicative power of compounding interest working silently for you year after year.
There's a great example of this with the boxer Floyd Mayweather, an incredibly high-intensity, high-income athlete.
He's earned staggering amounts of money. But his financial strategy, as described by a former partner, was just a simple cycle.
Fight, get the money, spend the money, fight.
And then repeat, fight, get the money, spend the money, fight.
That is the ultimate work-spend cycle, isn't it?
It's a treadmill, a really fancy high-income treadmill, but the intensity and the huge paychecks don't solve the structural problem.
Which is retaining and compounding the capital.
Right. You can earn $50 million in one night, but if that money's just spent, if it's not put into a system that compounds, you're always dependent on the next fight.
You're still just trading time and effort for money, and that trade eventually runs out.
It has to. Now, contrast that high-intensity world with the story of Osceola McCarty from Mississippi. This is one of the most powerful stories in the book.
An incredible story.
She had a 6th grade education. She spent 75 years of her life washing and ironing clothes.
So not a high earner by any stretch. She didn't have fancy financial advisors.
None of that. And yet, when she retired, she had built a considerable fortune. She famously donated $150,000 to a local university for scholarships.
How did she do it? It wasn't a big score.
Not at all. She did it simply by living frugally, consistently setting aside a small part of her earnings and letting that small amount accumulate and compound over a huge time horizon.
Her success was completely about structure.
It was about consistency and time. Those are structural elements. It had nothing to do with high income or hustle. She mastered the system of time, which is just so much more powerful than chasing a bigger paycheck.
Okay, but for compounding to really work its magic, you do need a certain amount of capital to start with. So sometimes you do need to increase your income.
That's true.
So if just working longer hours isn't the answer, where should you focus your energy?
The path to higher earnings is about shifting your mindset. You have to move from trading time to bringing leveraged value to the marketplace.
What does leveraged value mean?
It means becoming geometrically more valuable, not just incrementally more efficient.
Because fundamentally, we get paid for bringing value, not for the hours we work.
Exactly. The book uses this great example. If you help a company make $1 billion, paying you $52 million is just, quote, chicken feed. It's a fraction of the value you created. The market rewards that leveraged impact.
This sounds like that famous Jim Rohn quote.
It is. Don't wish it was easier. Wish you were better. For things to change, you have to change.
So you have to intentionally invest in yourself, in skills, in knowledge.
In things that allow you to impact outcomes on a much greater scale. In an economy that's changing so fast, if your skills are linear and easily automated, your income is going to stall.
But if you focus on solving higher value problems,
You're creating whole new categories of value, your income can grow non-linearly.
like Sarah Blakely with Spanx.
A perfect example. She heard no 1,000 times. She invested her entire life savings. But she succeeded because she created a whole new product category that solved a problem for millions of people.
She didn't just work harder than other salespeople.
No, she engineered a solution that scaled. That's what made her geometrically more valuable. Mastery isn't just about accumulation. It's about generating value that can grow over time.
So when we talk about all these structures and systems, it's easy to forget what's running the whole thing.
The human mind.
And it is fundamentally deeply flawed when it comes to dealing with long-term abstract problems like saving money.
We are wired for the here and now. We're wired for immediate survival, not long-term optimization. We solve the problem that's right in front of our face.
And this is where behavioral economics gives us some really crucial and sobering context.
It really does. We are evolved to choose today over tomorrow. It's a concept called present bias.
The classic study on this is the one with the banana and the chocolate cake.
Yes, if you ask people 2 weeks in advance, they'll say, oh, I'll have the healthy banana. But when the choice is right there in the moment.
80% choose the immediate reward, the chocolate cake.
And that's exactly why saving money feels like a loss. People know they should save. They plan to do it next year or next month.
But today, they spend.
Because saving means giving something up right now. And our primal brain registers that as a genuine loss. It creates resistance.
And that resistance leads to inertia, which is one of the most powerful forces in all of finance.
Absolutely. The example of organ donation forms in different countries is just profound.
So in countries where the default is not to be a donor, you have to check a box to opt in.
And the participation rates are very low.
But in countries where the default is set to donating and you have to check a box to opt out.
The rates are incredibly high. People hate checking boxes. They stick with the default. Inertia is basically a decision in disguise.
And that same inertia is why so few people make a financial plan or even sign up for their 401k, even when there's free money on the table with an employer match.
It just seems complicated. It's overwhelming. So they put it off. They do nothing. That is the default setting.
But the single most destructive instinct we have in finance has to be loss aversion.
Oh, without a doubt. The idea that the psychological pain of a loss is so much greater than the pleasure of an equivalent gain.
The study with the monkeys and the apples illustrates this perfectly.
So you give a monkey 2 apples, then you take one of them away.
What happens?
The monkey is enraged. It's not happy that it still has 1 apple. It is furious about the apple that it lost.
The focus is entirely on the loss, not the remaining gain.
And that rage, that outsized emotional response, is exactly what drives people to panic sell at the bottom of a market crash.
Cementing their losses, guaranteeing they miss the rebound.
It all comes down to a basic human need, the need for certainty, the need to feel secure and comfortable and in control.
And that need is what dictates a person's true risk tolerance.
We might fill out a form and say, sure, I can handle 20% loss intellectually. But when the market actually drops 20%, that primal need for certainty just takes over.
If that need is high, you will not be able to emotionally handle the risk, no matter what the spreadsheet says.
Which leads to a crucial lesson here. Your investing has to be done in a way that gives you psychological peace of mind.
So a mathematically perfect portfolio is useless.
If it's not emotionally perfect for you, if you have high-risk investments that cause you so much stress that you can't sleep, or it's damaging your relationships, then those investments are failing.
They're counterproductive to the whole point of it all.
Exactly. The purpose of this is economic freedom, but not at the expense of your well-being. If someone needs a portfolio full of treasury bills to sleep at night, then that's the right answer for them.
Even if the returns are lower on paper.
The psychological cost of that anxiety is far greater than any marginal financial gain you might get from taking on more risk than you can handle.
The book tells that story of the millionaire who flew coach to save a few dollars.
And it caused constant fights with his wife. He had the money, but he didn't have the emotional mastery to use it to create peace. He had to literally allocate money to a dream bucket just to give himself permission to upgrade their flights.
It just shows that the scoreboard is useless if you're not playing the game with emotional control first.
If your strategy forces you to violate your own core need for certainty, you will break your own system. Every time. Survival has to be the priority, both financial and psychological.
Okay, so if the system is designed to profit from us and our own psychology is working against us, how does anyone actually win this game?
You have to replace the flawed emotional guesswork with superior, impartial systems.
Systems over predictions.
Exactly. And the evidence for this is just overwhelming, thanks in large part to the work of Jack Bogle, the founder of Vanguard.
He showed that trying to pick the next great stock or the next genius fund manager is mostly useless.
It's mostly luck over skill. His analogy for this is so important to understand.
The gorillas in the gymnasium.
Right. You put 1,024 gorillas in a gym, teach them to flip a coin. One of them will, by pure chance, flip heads 10 times in a row.
And in the investment world, we call that gorilla a genius and pay them millions in fees.
But it's just luck. And the key point is that the cost of trying to find that lucky gorilla, the active management fees, is what kills your long-term returns.
So wait, does that mean skill doesn't exist in finance? If it's all luck, why bother?
That's the critical distinction. Bogle wasn't arguing against structure. He was arguing against selection.
So the skill isn't in picking the winning stock.
The skill is in designing a system like a low-cost index fund that captures the entire market's return while systematically removing the drag of high fees and the risk of manager failure.
Let's really dig into the math on those fees because it's so often misunderstood.
It's a killer. An active fund might cost you around 2%, all in. If the market returns 7%, you're only getting 5%.
Which sounds small, just a 2% difference.
But over 50 years, the compounding effect is devastating. Let's say you invest $1. At about 7% with low fees, it grows to around $30.
Okay.
But that same dollar, after losing 2% to fees every year, so compounding at 5%, it only grows to about $10.
Wow. So the investor puts up 100% of the money and takes 100% of the risk.
And gets only 30% of the long-term reward. The other 70% of the total growth was eaten by fees.
That is a staggering transfer of wealth.
It is, which is why minimizing costs through a systemized passive approach is a foundational rule.
So that's step one. What's next? We have to design a portfolio that can actually survive the inevitable surprises.
This is where Ray Dalio's work is so critical. He runs Bridgewater Associates, and he's obsessed with preparing for uncertainty.
Dalio famously predicted the 2008 crisis, but he's less about predicting and more about protecting, right?
Exactly. His research shows that most traditional portfolios, like a simple 50-50 stock and bond mix, are really fragile.
They have a strong bias to do well when times are good.
And terribly when times are bad. They're basically just a bet that stocks will keep going up. And Dalio warns that using simple correlation for this is like a primitive culture doing a rain dance. You're confusing coincidence with causation.
Yeah, and the data backs this up.
It does. Between 1973 and 2013, in a 50-50 portfolio, the S&P 500 was responsible for over 95% of the losses.
So the stocks give you the upside, but they are almost entirely responsible for the downside.
Which means protecting the downside has to be the most important rule. A 50% loss requires a 100% gain just to get back to even. It wipes out years of progress.
So the goal isn't just getting the highest average returns. The goal is surviving the ride.
The greatest investors look for something called asymmetry.
Massive rewards without massive risks. Opportunities where the math is skewed heavily in your favor.
Right. They think differently. Take the example of Kyle Bass and his trade with U.S. nickels.
He bought $2 million worth of actual nickels.
Because the market price of the metal inside the coin, the copper and nickel, was actually worth more than the coin's face value of 5 cents.
So he was looking for what you'd call a riskless return.
As close as you can get. The risk was almost zero because the coin is legal money. It's guaranteed by the government to be worth 5 cents. The metal inside was worth maybe 6 or 7 cents.
So if the metal price went down, his downside was capped. He could just cash them in.
Exactly. His downside was basically the cost of moving the coins around. But his upside was huge. That is structured asymmetry.
And we see this in other areas, like in certain real estate strategies. The book talks about lending secured by a first trust deed.
A great example. This is where you lend money, but it's secured by a physical property.
Right.
Let's say you loan $50,000 on a home that's worth $100,000.
A very conservative loan-to-value ratio.
Very. And because you have the first trust deed, if the borrower defaults, you're the first person in line to get paid from the sale of the house.
So this structure allows for pretty good returns, maybe 8 to 10%.
Much higher than safe bonds, but with massive downside protection built in. For you to lose your principal, the house would have to fall more than 50% in value and the borrower would have to default.
It's all about focusing on safety and downside first. That's how you win the game of survival.
So if structure and downside protection are the foundation, then time is the engine.
The engine that drives it all. But our minds are just not built to grasp the scale that time enables.
We think in straight lines, but wealth grows geometrically. And this failure of imagination is why people so often misjudge what they need and why they undersave.
Let's use that famous scale comparison. How long ago was 1 million seconds?
12 days. It feels recent, manageable.
Okay, now how long ago was 1 billion seconds?
This is where everyone gets it wrong. It's not a few months or even a few years. It's 32 years ago.
That's just a staggering difference. 1 million is 12 days. 1 billion is 32 years. We use those words almost interchangeably, but they are worlds apart.
And that blurring of scale is why financial goals can feel so impossible. We treat millions and billions as roughly the same level of unachievable.
And 1 trillion seconds.
Nearly 32,000 years ago. When we hear numbers in the trillions, our brains just shut down. We can't grasp the magnitude.
And this failure to grasp geometric scale relates directly back to compounding.
It's the biggest weapon the individual investor has. Starting early, no matter how small the amount, is everything.
The charts on this are brutal. They show the incredible disparity that time creates.
An investment of just $5 a day, which is what, $150 a month, can grow to over $2.5 million over 50 years. Assuming historical returns.
And if you double it to $10 a day.
Over 5 million. But the key isn't the specific number. It's the geometric force of time. The earliest money you put in does the most work because it has the longest time to compound.
It's that silent, steady consistency. That's the force that linear effort can never match.
But we have to come back to the rule. Knowledge is not power.
Action is. Execution.
You can know all of this, you can have the perfect plan, but if you don't execute, it's all worthless. And so many people fail here because of the psychological roadblocks.
This goes back to the primal brain. For you to actually execute a plan consistently, the change has to be a must.
An absolute necessity, not just a should, which is like a soft preference.
And to maintain that must state, you have to deal with what the book calls your limiting stories.
Those internal narratives. I'm just bad with money, the system is too complicated, money is the root of all evil.
These stories are like psychological brakes. They sabotage any attempt at execution.
But when you can change your story, when you can detach from that limitation, you can act. The example of Julie and Colin is perfect.
They were just paralyzed. They saw the financial world as too complex.
But once Julie decided that their financial future was a must, they took action.
A very simple action.
A very simple structural change. They just transferred their IRA into low-cost index funds. By changing the story that held them back, they executed the strategy.
And that one move, just by cutting fees, was estimated to put an extra $150,000 to $250,000 in their pockets over their lifetime.
The strategy wasn't new. The mental frame was. Changing the story allowed the strategy to finally work.
So the strategy is almost invisible until you put yourself in that determined state of mind.
The state and the story together. They allow you to find the right strategies and, more importantly, execute them consistently over the decades needed for compounding to do its work.
So ultimately, this whole journey of mastering money, it isn't really about the number in the bank account, is it?
Not at all. Money is a tool. It's a source of power. And true wealth mastery is about control.
Optionality.
And freedom. Freedom from having to make forced, stressful decisions.
So it shifts the whole focus. It's not about maximizing how much you accumulate. It's about maximizing how useful that money is to your life.
Getting the maximum benefit for the minimum cost and complication.
Which is why you don't have to own the jet to live the lifestyle.
Exactly. You can rent it, you can charter it, you get the same utility at a fraction of the cost, and you avoid all the headaches of ownership.
Or the example of Magic Johnson buying the LA Dodgers. The team sold for over $2 billion.
But Magic didn't put up $2 billion. He became a partial owner. He got the joy, the pride, the fulfillment of ownership.
All the benefits and optionality, but at a fraction of the cost and risk. That's mastery in action. Maximizing the experience, optimizing the capital.
And behind this whole quest for control is a really deep human need, the need for significance.
The need to feel important or special or unique.
And that need can be a double-edged sword. It can be destructive. You see it in violence or people who find their identity in having problems.
Or it can be constructive through achievement, creativity, or contribution.
But just achieving wealth doesn't guarantee fulfillment, especially if your wealth becomes your identity. We see the tragic story of Adolf Merkel, the German billionaire.
He was completely driven by significance, and when he lost a lot of money in the 2008 crisis, his identity collapsed.
Now contrast that with the life of Chuck Feeney, the co-founder of Duty-Free Shoppers.
An incredible story. He built a fortune of over $7 billion.
But he lived with extreme humility. Flew coach, wore a cheap watch. His entire focus was on contribution.
By the time he was in his 80s, his bank account was almost empty on purpose.
He had chosen to give away his entire fortune through his foundation. He modeled what the book calls the power of a life well lived. Mastery wasn't about keeping the capital. It was about directing its power.
And this leads to the ultimate goal, which isn't wealth, it's contribution and fulfillment.
The Dalai Lama observed that the one thing that connects all of humanity, from a goat herder to a Wall Street trader, is the desire to be happy.
And we have studies that show a direct, measurable link between giving and well-being.
The act of giving, of volunteering, it's linked to lower rates of depression, higher levels of happiness. The psychological benefit is equivalent to getting a major raise at work.
A psychological return on investment.
Exactly. And the essential insight here is that the secret to living is giving. Money is a tool for meeting our needs, but the act of giving actually teaches our brain a powerful lesson. It teaches the brain that there is more than enough. It shifts your mindset from scarcity, which leads to fear and hoarding, to abundance. And that abundant mindset is what gives you the psychological strength to stick with the long-term plan.
So the real scoreboard isn't your net worth. It's the control and the optionality that money gives you to live a good life and to help others.
Mastery is applying all these principles, structure, time, emotion, to build a system that ultimately sets you free. The decoding reveals that this is a game of psychology and structure.
Money. Master the game does not mean win money. It means understanding the structure well enough that the game stops controlling you.
Money is never the goal.
It's the result of correct thinking, disciplined behavior, and systems that survive time.
When money becomes the goal, people break their own rules.
And when rules break, the system collapses.
If this episode changed how you see money, risk, or time, the decoding is working.
And if you want to understand life beneath the surface, one book at a time, subscribe to Decoded by Morrow.
We don't teach success. We decode how systems actually work.
You've reached the end of this exploration, but not the end of the idea. Let it echo. Let it integrate. And when you're ready for the next step, return to Decoded by Morrow. Wisdom is a journey, not a conclusion. Let's decode.